Okay, welcome. Welcome to the Sphere Home Loans Mortgages for First Home Buyers webinar. My name's Rachel Kroon and I'm the Director of Sphere Home Loans. I'd like to begin by acknowledging the traditional owners of the land in which we meet today. I'd also like to pay my respects to the elders both past and present. We have a jam-packed agenda tonight. I'm going to fit as much information as I can into the hour that we have. The topics that we're going to cover are up on your screen at the moment. If anybody has any questions at the end, there's going to be a Q&A. I know a lot of people have sent questions in when they've registered, so thank you for all those questions. If you do have any questions that aren't answered today, or if you'd like to have something answered specifically for you, please reach out to my team, hello@spherehomeloans.com.au. I work with an amazing team of mortgage brokers and we're here to help. We love giving information to people along their journey. So if you ask any questions to that email address, someone will come back and answer anything that you'd like. So I just thought I'd start with a basic buying process from a lending perspective. Now, when you're buying a property, there's the real estate perspective and the legal perspective. This is just from a lending perspective. Now, a lot of the people on this webinar are probably a lot further on the process than this, but I thought this would be just a nice little summary of the steps that you take when you first, enter the market. So step one is making an appointment with the mortgage broker. So you can do that at any stage in the process. It's never too early. And from there, you'll discuss how much you can borrow, if you're eligible for any government grants or incentives. We can also discuss how much deposit you'll need. When you decide on how you're going to buy, so you know how much deposit you're going to have, whether you're going to use a parental guarantee, whether you're going to purchase with or without mortgage insurance, we have a next appointment. And that's generally where we discuss what banks we're going to use. We talk about potential banks. We can compare loan structures. On that first appointment, there's really not a whole lot of point in talking about what banks and what rates and what loan structure, because we don't yet know how you're going to structure your lending. So when we do know, that's when we start to do the comparisons. So when we've compared all the banks, you choose a lender from those comparisons that suit your needs, and that's when we apply for a pre-approval. When you're pre-approved, you're ready to go and find your home or your investment property. Pre-approval moves to formal approval when a property is found. So generally, when you're pre-approved subject to an acceptable property. The bank then gets a valuation done, and then it moves to what's called a formal approval. So if you've got a standard contract, settlement takes place about 42 days after exchange, and that's when you take possession of the home. Your loan also starts from that day. So how much can I borrow on a home? This is what we talk about. How much percentage can I borrow? How much deposit do I need? And what can I actually secure against a property? So I've got a couple of scenarios here for you. There's 4 different houses. They're all worth $500,000 and they've all got a different structure there. So the first one is a loan amount of $525,000. So this is a worst case scenario. These clients are borrowing 100% plus all associated costs. I'm going to assume that these people don't qualify for a stamp duty concession, so they have to pay stamp duty, which is why they cost us so much. Now, you can do this, but you can't do it without help. So you would need to utilize a parental guarantee to be able to borrow 100% or 105% of the purchase price. Now, I'm going to go into parental guarantees in more detail very shortly. The next house is a 95% lend. That's a $470,000 loan against a $500,000 property. Now, this is the maximum you can borrow without any sort of help. So if you're borrowing 95%, you pay what's called lender's mortgage insurance. Now, lender's mortgage insurance, for those of you who don't know, is a one-off fee that you pay to the bank when you organise your loan if you're borrowing over 80%, and that insures the bank against you as a risk. So you're not insuring anything to do with your loan, you're insuring the bank's risk. Now, mortgage insurance is worked out on a sliding scale. So you will pay mortgage insurance based on the percentage of a loan amount. the higher the percentage you borrow, the higher that percentage is. And obviously, because it's worked out as a percentage of the loan amount, the higher the loan amount, the higher the mortgage insurance. Now, in this particular case, the mortgage insurance was about $15,000. Now, some lenders will let you capitalize that into the loan over 95%. So you can go up to 97 or even 98%. But just to be general, it's a 95% lend is the maximum you can do without any sort of assistance. Now, if you were eligible for the first home guarantee scheme, you may not pay lenders mortgage insurance. I'll go into that a little bit later as well. So that guarantee is what actually covers that lender's mortgage insurance payment. The third house is a $450,000 loan. So these people have a 10% deposit and they're borrowing 90% of the value of the property. Now, they would still be paying lenders mortgage insurance in most cases because you're still borrowing over 80% of the value of the property. But in this case, you can see the mortgage insurance is $10,000, which is less than the 95%. That's because it's worked out as a percentage. Now, not everybody pays mortgage insurance at 90%. There's certain industry waivers for certain professions where you don't pay mortgage insurance at 90%. And we'll go into that in a little bit more detail. But if you're not qualifying for one of those waivers, you'd be paying mortgage insurance at 90%. So you can definitely get into the market. You can definitely pay the mortgage insurance. You just have to understand what that fee is going to be able to get in sooner. The fourth house is a $400,000 loan against a $500,000 house. This is your standard 20% deposit, plus any costs that you would have. And you've got a 20% deposit, so you're only borrowing 80%. You would pay no mortgage insurance here with any lender. There are some lenders, just to note on that do go to 85% without mortgage insurance for all industries. So it's not always 80%, but just because we're going through this in general terms, I'm going to say 80% because that's the vast majority of lenders. So that's just a little bit on how much I can borrow on each security. Next up is borrowing capacity. So just to explain what borrowing capacity is, it's how much you can borrow, and that's based on a few things. The bank will work out your borrowing capacity based on your income. So if you're a single, just yours. If you're a couple, it'll be both of your incomes. And they'll work out your living expenses. Each bank has a minimum amount of living expenses, and that's worked out on your family unit, whether you're a single, a couple, how many children you have. Now, the banks have a minimum living expenses, but your living expenses might actually be more than that. You might have certain expenses that we need to take into account, and we'll work through that with you. You'll also have any sort of debts come off that. So if you've got a personal loan that you're paying out, that comes out, and then we work out at the end of all of that what your disposable income is. And that's how we work out what's available to pay a mortgage. Now, just when we talk about borrowing capacity, I'd like to say that for the majority of first home buyers that buy with our business, it would be very rare for a first home buyer to actually go to their maximum borrowing capacity. Now, the slide before that we were talking about how much can I borrow, generally it's deposit that holds a first home buyer up. And they're madly saving for a deposit. But generally, the bank's going to lend you more than what you actually want to borrow when it comes to borrowing capacity. One of the really common questions that came up in the pre-webinar questions was, how much does help debt affect my borrowing capacity? Should I pay my personal debts out before I borrow? Should I pay my help debt out before I borrow? Now, the answer to that question is there is no general answer to that. You really need to work out for you specifically how that's going to look. And the way you would do that is by reaching out to a broker. You can reach out to our team on that hello@Sphere Home Loans email address and ask the question. We can work out for you what you can borrow with and without your debts, what you can borrow with and without your help debt. And I think it's really important if you're considering paying out a debt before working out a borrowing ability, you should really work out how that would look both ways first, especially before you do something that might not be reversible, like paying out a help debt. So just for some clarity of what impact these have on different loan amounts, I've done a scenario here, and this is actually a scenario that I'm working on now. There's two applicants. One applicant has an income of $92,000 and the other has an income of $113,000. Now, they actually don't have any dependents, they don't have any debts, and they don't have a help debt. Now, their maximum loan amount, just a little disclaimer, I've only worked this out on one bank's calculator, and I'm working this out on today's rates. So this isn't an indication of how much you can borrow on this income. This is just to work out the impact that these things will have on borrowing capacity. So their maximum loan amount is $1.1 million. Now, I've just done some things in the calculator to work out how that would change with different things. So if I popped 2 children into that calculator, their maximum loan amount would go from $1.1 million down to $1 million. So it changes $100,000, those 2 children. If that same couple had no children and a $20,000 credit card, they could still borrow $1 million. So the $20,000 credit card actually changes the borrowing capacity the same amount as the 2 children. Now, it doesn't matter if that credit card never gets used or if it's fully drawn. The banks look at all credit cards as fully drawn. So they can impact what your borrowing capacity quite substantially. Now, you can check when you're doing a pre-approval what you can borrow with or without your credit card. You don't need to close it first. We can get pre-approval subject to the reduction or the closure of a credit card if it's going to impact your borrowing capacity. Now, step 4, they have no children, no credit card, but one of the applicants has a $100,000 help debt. So in this case, their borrowing capacity would go to $1,050,000, which is more than if they had a $20,000 credit card, but their help debt is $100,000. Now, I've included this this scenario to help show you that the banks look at help debt very differently to personal debt. And that's because of the repayment situation with a personal loan. So with a personal loan or a credit card, there's a payment that gets made every month. And there's buffers that get added to that. But with a help debt, it doesn't matter if you have a $5,000 help debt or a $100,000 help debt. There's a change to your net income that works out as a percentage. So the repayment is not really repayment, it's a change in your net income. So if this particular couple if they did have that help debt and they had $100,000 help debt and they wanted to buy for $1 million and they had a $200,000 deposit, if they wouldn't pay down that help debt, it's not stopping them being able to borrow what they want. But if they put half of their deposit onto their help debt, they wouldn't have enough to get into the market. But if the same situation, there was a $5,000 help debt and they wanted to borrow $1.1 million, well, they would definitely pay that help debt out. So I guess what I'm trying to demonstrate is it's really good to look at it both ways before you make a decision. Now, point 5, the couple have no children, no credit card, no help debt, but they've taken out a $50,000 salary packaged car lease. So for those of you who don't know, a salary packaged car lease is something that is offered through an employer. It's quite a tax effective thing. You can pay for the entire amount of your car loan, but also your fuel and your servicing. And a good chunk of it's taken pre-tax. So it can be tax effective and people love to get these, but they do really impact borrowing capacity because the bank looks at it as there's an entire payment coming out, even though these other things are getting covered. So if you were looking at borrowing the next few years and considering taking out any sort of salary package thing that's attached to a debt, like a car, there's some other things as well. It's just good to check with somebody how that's going to impact your borrowing capacity before you make a move, because a lot of those salary package car leases last for 4 or 5 years. So you don't want to get into something before you want to go and buy a house that might impact what you can do. So that's just a little bit on borrowing capacity. We'll move on to industry concessions. This is a really hot topic at the moment. So industry concessions, a lot of banks call it different things, like their, specialist policy. What it is a certain amount of industries that get special deals with the bank. There are a lot more than I've got listed here, but I've listed some of the main ones. Now, there's different offers that get made for certain industry professionals, and sometimes that is great rates, a different sort of product. But the main one that people use, the hot one that people want to get into, is 90% with no mortgage insurance. And that's available for all of the industries listed here, but different banks have different policies. So I just wanted to cover off, there's a midwife there, that's only just been added. So that's really exciting. There's a psychologist there, that's just been added. There's an accountant there. Now, accountants are one that might have an income cap. So one bank might say, well, we'll do the 90% mortgage insurance for you if you earn a certain amount. But then there might be another bank that doesn't have an income requirement for that same accountant. So they do differ greatly, and all banks have a different policy. Now, the benefit of the 90% no mortgage insurance policy is where you can buy with a 10% deposit. You don't need to pay mortgage insurance, and you still get the same rate. The product doesn't change. Industry concessions is a policy, it's not a product. You still get the choice out of all the lender product suite, and we still can negotiate the rates just as aggressively. Now, I'll give you a scenario of some of these that might change between banks. I had a millennial money client come to me, it's nearly 2 years ago now, and she was an optometrist. At the time, she already had a pre-approval with her bank. Her bank had advised her that they didn't have optometry in their medical package and that she didn't qualify. So she'd gone and got a pre-approval and she was all ready to buy, and she was going to pay $10,000 in lender's mortgage insurance. We had a chat and we found out there was another bank that she did qualify for the industry waiver. Now, saved that $10,000 in mortgage insurance and got in with a 90% no mortgage insured loan. The rate was actually better. So she didn't lose anything by doing that. She actually just saved. But you need to be able to see what you qualify for to be able to do that. Now, that same client is in that house still, and she's looking at buying her first investment property. And because she's with a bank that has a 90% no mortgage insurance policy, that's not just for your own home, that's for your next home as well. So she's able to pivot the equity she's got in her own home that she's built and only have the 10% deposit needed for her investment property. So this can be quite lucrative across your entire portfolio. When it comes to industry professionals, there's some things that I haven't listed here. Some medical professionals can go to 95% without mortgage insurance. There's some banks that are offering 95% with no mortgage insurance for different industries that aren't listed here, but they might have a little bit of a loaded rate or something different, and that might be worthwhile for you. Teachers and registered nurses are something that do have offers at certain banks. It's not a straight 90% no mortgage insurance without a higher rate. There is a slightly higher rate, but it's just worth checking what you can do. As I said, these vary greatly between banks and lenders. So if you're one of these professionals, it's just really important to let your mortgage broker know that you or your partner is that when they're doing their scenarios for you early on. The next one is parental guarantees. Now, this is a really hot topic at the moment. I would say about 30% of the first home buyers and first home investors that we're doing lending for at the moment are utilising a parental guarantee. A parental guarantee is basically a policy that says that you can borrow 105%, up to 105% of the value of the property, but you're utilising some equity in your parents' or a family member's home to bridge the gap in what deposit you have saved. So the more you've got saved, or the less your costs, the less the guarantee is going to be. But in essence, it's a security guarantee that bridges the gap to enable you to borrow more than if you didn't have a parental guarantee. Now, parental guarantees really vary between banks. They're all very different. Some banks have what's called a limited guarantee. We would only recommend a limited guarantee to be used. You don't want your parents putting up their entire home or guaranteeing your entire loan amount. I've done a scenario here that might help. The $500,000 house is the house that you're looking to buy. I've gone for a worst case scenario here. So your house is worth $500,000 and you want to borrow 100% plus costs. I'm assuming that you don't get a stamp duty concession and you need to borrow the full $525,000. So you can borrow $400,000 against your house, and you've got $125,000 that you need to secure against a parent's home. And that's done in a limited guarantee situation. Now, it looks like two loans here, but it doesn't necessarily have to be two loans. With a lot of lenders, it's one loan that you have, and it doesn't look any different than any other loan, but in the background, there's a security guarantee. Now, a couple of things about parental guarantees. Generally, there's no cash to pay for the parents. You don't pay lender's mortgage insurance. The parents can choose the amount of the guarantee. So they might say, we're happy to guarantee this certain amount. And it might mean that you need to save a little bit more to put in, or it might mean you need to buy a little bit less. But the guarantee amount changes based on how much you put in and how much you're borrowing for. The guarantee isn't connected to your loan for the life of the loan. It's connected until you are able to stand alone, equity-wise. So to explain that, I'll use the scenario here again. So let's say you bought this house for $500,000 and you've got these two loans joined together. You've got a loan amount of $525,000. So that's 105%. We need to get to 80% to release your parents. So let's say that house is now worth $600,000. It's a few years down the track. You've done a few renovations. It's worth $600,000. And in that time, you've also paid $45,000 off that loan. So you've got $480,000 owing. Well, $480,000 is 80% of the value of $600,000. So at that time, we would organise a valuation to be done, and that's when your parents can be released. A couple of things about parental guarantees. They don't necessarily have to be your first home. So a lot of people think that parental guarantees can only be used for first home buyers. That's not the case. They can be used for second home buyers. They can be used for investment properties. We have a lot of clients that use a parental guarantee for an investment property. They can be used for a home when you've already got a home. So some people might have a home and they're looking at buying a second property, but they don't have sufficient equity in their first. Well, you can still use a parental guarantee even if you have a home with some lenders. Some banks don't allow your parents to have a mortgage, but some do. So there's cases where your parents might have a mortgage with a small credit union that don't offer parental guarantees, and they really want to keep that mortgage. Well, there's banks that will allow a parental guarantee to go behind that mortgage, and they can keep their mortgage exactly where it is. I'll give you, when you are doing a parental guarantee loan, it's really important to involve your parents or whoever's offering you the guarantee in the process. So our process from a mortgage broker's point of view is we meet with you and we chat about things, and we might uncover the the possibility of a parental guarantee. From there, the best thing is for us to meet both with yourself and your parents and talk about everything. So it's really important when you're doing a parental guarantee that we're choosing a loan and a bank that's suitable not just for you, but also for your parents. Sometimes then from there, we'll meet with your parents separately alone. And a lot of time there might be some hesitations that parents have, and they want to talk about all of those openly. I'll give you an example. I've had a client where we did have a meeting, all five of us had a meeting, and there was a few hesitations from the parents to do a parental guarantee. Now we've met afterwards one-on-one just to go through a few things, and their hesitation wasn't that their son wasn't going to pay the mortgage back. He was a school teacher, his wife was a nurse, and they were really confident about that. They weren't worried about that. In that conversation, we uncovered that their concern was that they were looking to retire in a few years. And at the time they were going to retire, they were going to pay out their mortgage. They had a mortgage in place, and they were going to downsize to a unit. Now, when we had that conversation, we realised that they just had to go with a lender that offered portability. So they went with a bank that allowed them to pick up that guarantee and move it. And they did. They did the guarantee, and in a few years' time, they did sell their home. They paid out their mortgage, and we picked up that parental guarantee that was still there, and we moved it to the unit that they downsized to after they retired. All those things can be looked at and done, but we just need to work out not just what's right for you, but what's right for your parents to make sure we're getting the right structure for everybody involved. When it comes to parental guarantees for investment purposes, they're great. A lot of people, I guess, even if they have a deposit and they're buying an investment property now, but then they're buying their next property to live in a few months' time, will utilise a parental guarantee so they can borrow this situation of 105% plus costs. If you have parents that are happy to do that, and a lot of the time it's the parents contacting us saying, we want to be able to make sure our kids are, maximising their portfolio at the start. Sometimes utilising a parental guarantee is a great way to do that. I have a client that purchased her first investment property a few years ago using a parental guarantee. She didn't put any cash in. She borrowed 100% plus costs. That property went up in value, went up a lot in value in the few years that she had it. And then she released the guarantee and then used the equity that she had built in that property to buy a second investment property. So she essentially then had 2 investment properties and she put no cash in at all. She wanted to save her cash to go into her owner-occupied property down the track. So there's a lot of tools that can be used with parental guarantees to make them really effective. My advice, if you're looking at a possibility of a parental guarantee, is get your parents involved early. It's also not getting caught up on what bank you want. So us as mortgage brokers, we're going to negotiate you a great rate and a great product at any bank. It's very close between the banks what the rates are going to be. What's most important for you is getting the structure right that's going to be your parents are going to be happy with. And with the mortgage insurance that you're saving, don't get too caught up on the bank. Get caught up on the structure, and then we will price that loan. So just on that, a parental guarantee isn't a product. Some people say, well, what are the rates of parental guarantees? It's not a product. Like the industry savings, it's a policy that sits behind. So the policy that you've used to get into this home is a parental guarantee, but you've still got a full choice of the product suite of that bank. So with a lot of lenders that we use, we get great rates for parental guarantee loans because technically we're getting pricing at 80%, which is a low risk loan. You can get fixed, you can have variable, you can have the full product suite, and the rates are just as aggressive as if you were not doing a parental guarantee. Now, we're at the stage now where we know what you're buying. So going down those points before, we know how much deposit you've got. We know what your borrowing capacity is. We've talked about structure. We know if you're getting some sort of government grant. We know if you're going to be using an industry concession or if you're using a parental guarantee. And then we get to the point where we're talking about how we're going to structure your loan. So you might... So rate is one thing that we compare, but the other thing is what sort of product you're going to have. Now, when you meet with a broker and have a talk about these things, it's really important for you to know what's important to you. What are your short and medium term goals? We need to know what they are so we can give you the best advice for your situation. Some questions that we might ask at this stage would be, are you going to rent this property out now or down the track? Are you intending to fix now or down the track? If you're borrowing over 80% and if you're paying lenders mortgage insurance, you may be with this lender for a while. So it could be hard to move. Is this lender the best choice for you today and the longer term? If you're buying with your partner or a friend, do you want the ability to separate your loans so you can pay a portion down at your own pace, or do you want to combine them? And are you going to have joint savings, or do you want to keep your finances separate? And will you wish to pay lump sums off your mortgage down the track? Now, there's a lot more questions we're going to ask you, but they're just some of the ones to get you thinking, to get you started. Now, I'm going to move on to some basic structures for home buyers. So sometimes a basic product is the most suitable thing, but sometimes it's not. And we need to talk about all the different products so you can choose the loan that's right for you. So I'm using a scenario here where we've got a first home buyer buying a house. It's $500,000. I love $500,000 houses. And they've got a 20% deposit. So they're borrowing $400,000. Now they've decided that they like their home loan. They like their loans combined. They want to combine their savings. However, they want to have multiple offset accounts. Now, I'm just going to explain quickly what an offset account is. An offset account is a normal bank account. You all have one. It has a key card attached, or it might not. You can choose, but it's just a fully functional bank account. Now, those dots in the background show that it's linked. So an offset account is simply just offsetting the interest on your mortgage. Any money in that bank account today, you don't pay interest on. Offset accounts are great. Some banks have one per loan, some have as many as you like. This couple wanted to have 3 offset accounts. They wanted to have one for their salaries. They're both on good salaries. They're going to have a joint salary account, and they want their money to be working every day for them. So they're going to have a salary account that's linked to their home loan. They're going to have a second account for their bills. They want to have it separated so they know what's paying. They've got money allocated for certain things coming up. and another one for a savings account. Now, if you've got a mortgage, the best place for your savings is offsetting your mortgage. Now, you could have a high interest savings account sitting there for maybe 3%, and you would then pay tax on that 3%. Or this whole mortgage might have a 5% rate. So by offsetting your savings against your home loan, you're essentially getting 5% on your savings tax-free. So in this case, let's just assume that they've got $2,000 in their offset account one. That's their salaries have gone in, and they've got $8,000 in their bills account. They want to use that money quite soon, but it's sitting there for bills right now. And they've got $10,000 in their third offset account. So the combination of all three of those offset accounts is $20,000. Their mortgage is $400,000. So today they're paying interest on $380,000, not $400,000. Now, it's common that people get confused between offset and redraw. Redraw on that variable home loan for $400,000, that's probably got redraw attached to it. Now, they could pay that $20,000 off the home loan, and then they may be able to redraw that back out. So a lot of the time, that's all somebody requires. But offset offers maximum flexibility because it never goes off your home loan. It's always in a separate bank account, and that can be important in some cases. Now, here's another situation where the same amount of money is getting borrowed against the same level of security. However, these people are buying their friends. They're buying with a friend, and they want to keep their finances separate. So what we've done here is we've separated that loan. There's one loan for $200,000 each, and they've both got their own offset account. Now, there's a couple of ways we can set this up. Most banks will let us do this split under a standard package, but from the bank's perspective, those home loans are in both names. These are split just for your accounting purposes, and you're jointly and severably liable for the debt. But one person might have $100,000 that they consider an offset that they're not putting into this transaction, and they just want it to sit against their side of the mortgage. So we can do a split like this. There's some banks that will allow each of those home loans to go into separate names with the other party guaranteeing it. Now, you're still guaranteeing the other person's loan. You're still using your house as security, but there is some banks that will allow a little bit of separation here. So if you are buying a friend, which is becoming increasingly common, there are certain products out there that a few banks have that can be, I guess, really well suited to this. Now, I'm going to go back to this initial situation where these clients have a variable home loan. Now, I'm going to assume that they said to me they would like to fix a portion down the track. They don't want to fix right now, but they want to fix down the track. I'm just going to stop there and explain that the biggest, I guess, mistake that I see first home buyers make is fixing their entire loan. So many people go into a bank and they look at a really good 2 or 3 year fixed rate, and they will fix their entire loan without fully understanding the repercussions of that. If you fix a loan, you're in a contract for a period of time. There can be hefty penalties of getting out of that fixed loan. So you really need to understand what you're doing for the period that you're going to fix for. You also don't have the ability with most banks to have offset, and there's restrictions on how much you can pay. So I just think before you fix, I'm all for fixing for security. I just feel like you really need to work out how you're going to structure your fixed loan and what's the best setup for you. I wouldn't just go in and fix the whole thing without really thinking about it. So let's go back to this scenario. These clients have said they want to fix a portion, but not too much. So we've set them up this way. They've got a $300,000 fixed loan for 3 years. They wanted that much locked for security. And when they said they wanted to fix for 3 years, we had to really talk about what they're going to do in the next 3 years. So they know they're going to stay in this house. They know they're going to have about $20,000 in savings at any given time. So we need to make sure that variable portion's $20,000, or there's nothing that those offset accounts would be offsetting. But then one of the applicants had bonuses that they got, and they said, well, we might get about $50,000 in bonuses in that time. So I need somewhere to put that. So this is a structure where we've got $100,000 variable. That's a really flexible loan. We can pay as much as we like off that loan. Or we could pay that down to $1 tomorrow if we wanted to without penalty. You've got full offset there, and then they've got their fixed loan down the bottom that they've got the security that they wanted. Now, this all sits under a package. All banks have, or most banks have, a very similar kind of package. There might be an annual fee. Some don't have a big annual fee. But basically what gets covered is everything under here. So, you have a fixed loan, a variable loan, offset accounts, and that might all come under that one package. So that's just a structure where it comes with a fixed and variable split. Now, it might be more appropriate for that client to have it all fixed. It might really suit them, but you just need to understand what you're actually doing and why before you make that decision, especially if you're going into something that's fixed, because it isn't reversible without some sort of penalty. It's important to note with fixed loans that the fixed break cost is an unascertainable amount. So at the time that you fix your loan, you can't ask what the break fee might be because you don't know. The bank works that out on their loss. So I've seen break fees for a 5-year fixed loan up to $43,000 because rates went down. So when you do fix a loan, you actually don't know how much that break fee is going to be. So I think it is really important for you to work out how long you're going to fix for and what might happen in that time. Now, moving on to investors. Traditionally, investors were a little bit different to they are now. Traditionally, people bought their own home first and they paid off their home loan. They built up some equity in that home, and then they used the equity in their home to buy an investment property. But then they've still got their own home loan, so they had somewhere to put their money. And then that was like a really simple structure for investors. It's changing. Rent vesting is getting increasingly popular. A lot of people, and rent vesting is when you're renting a home where you want to live and you're buying investment properties when you can afford to live. Another thing that's quite common now is living at home in your 20s and buying investment properties, or buying a property now that you're planning on renting out in 6 months' time. You know you're going to rent it out, so you want to set that up correctly at the start. When it comes to investments, when it comes to investment lending, it's really important to talk about offset. Offset's a big thing when it comes to investment lending, because the difference between offset and redraw is the biggest thing for anything that's going to be an investment loan, either now or down the track. And the reason is, if you have an offset account, it's a bank account. It's not considered to be paid off the loan. But if you have something in redraw, or if you have something on your home loan, it's considered to be paid off the loan. So you might say, oh, I've got a product that's fine, it's got redraw, I can draw that money out and use it later. Well, you can use it later from the bank's perspective, but from tax-wise, from investment-wise, that's not tax deductible debt. You've already paid that off your home loan. So offset's really important when it comes to investment lending. This is just a basic investment structure. So this client came to me and they've had a deposit of $240,000 and they're buying their first investment property for $600,000. They didn't want to pay mortgage insurance. So they've borrowed 80% of the value of that property, which is $480,000. Now, they could have borrowed 90%. A lot of investors do and pay mortgage insurance, but just for simplicity, we're going to 80%. So they borrowed $480,000 and they've still got $100,000 left. So what they do is they put that $100,000 in offset. Now, with that $100,000 in offset, they're only paying interest on $380,000. So let's just assume this is an interest-only loan. Let's assume the repayments are about 5%. So the repayments on $480,000 on interest only would be about $2,000 a month. But because they've got that $100,000 sitting in the offset, their repayments are more like $1,600 a month. So it's like making repayments on a $380,000 loan, but they've got the flexibility to use that $100,000 against a property, and they've still got $480,000 technically owing against this investment property. Now, when you're buying your first investment property, it's really important to, I guess, work out a structure that's going to be effective for your next steps. Now, I'm just going to assume that this client has come to me and said they want to buy another investment property. Now, let's say it's a few years down the track, and this house, the house that they've bought for $600,000, it's got a bit of equity in it now, and it's now worth $800,000. Their home loan that they took out to buy that property, we're going to call that home loan one, it has $480,000 owing on it. Because they did an interest-only loan, even though we're a few years down the track, they still owe $480,000. Now, their savings may have picked up. They might have $200 in an offset account now, and they're only paying interest on $280, but $480 is owing against property one. They've come to me and said they want to buy a property, another property, for $500,000. So I'm going to use the usable equity in their first property to enable the second property purchase. So we talk about usable equity. Obviously, we know that it can be more than 80%, but I'm going to say it's 80% for the simplicity of this scenario. So because the value of that property has gone up to $800,000, the usable equity is now $640,000. So they've got another $140,000 they can take out of that property equity-wise. We still have to work out borrowing capacity, but equity-wise, they've got $140,000 there. Now, because they want to buy a house for $500,000, we would get a separate loan split because we need it separate. It has to be separate so the accountant knows what's for property what. So $500,000, 20% plus costs, just in rough terms, is $125,000. So we would get that ready in a loan. You might get that ready now. We might get that ready to buy, or we might wait until you find a property and just have it pre-approved. But either way, whether you do it now or down the track, this is how it looks when you've actually bought the second property. So you bought a property here for $500,000 using the equity in property one. You've still got home loan one there for $480,000, but you've got a second home loan for $125,000. Now, home loan two is secured against property one, but the purpose of that home loan is for property two. Home loan number three is secured only against property number two. And we do that to allow maximum flexibility down the track. We don't want to cross these properties. It might give you restrictions for, if one valuation goes up and the other goes down, or we don't want to be restricted down the track or give the bank too much control over our portfolio. So home loan number three is secured against property number two. But when you're from the bank's perspective, one and two are against property one. But from your accountant's perspective at tax time, when he asks, well, what's the interest you paid for property two? You've got the combination of loans two and three. So in the first purchase here, he's borrowed 80% of the value of a property. But in property purchase two, he's borrowed 105% of the value, which is a great achievement to be able to do for an investor. He's still got his couple of $100,000 sitting in an offset account. Now, at the moment, he's not paying interest on those funds there, but at any time down the track, if he wanted to buy an owner-occupied property, he could just take that money out of offset and put it in a tax-effective environment of buying at their own home. So that's just a little bit about structures for first-time investors. Look, that's only a few structures. There's obviously a lot more that we can go into. I'd love for anyone who has any scenarios that they'd like to know just to reach out to the team. But that's just a few that might help you get started. I had planned to go into government grants on this webinar. It's a really big topic. It changes from state to state. I really think there's a lot of information to do with the government grants. If you do have a question about government grants or what you're eligible for in your particular state, reach out to the team. Someone will come back to you. I have brokers that specialize in first home buyers nationally. So wherever you are, we can let you know exactly what you're eligible for and help you along that process. But there was a lot of questions that came up in the webinar about the first home guarantee scheme. There seems to be some confusion, so I really wanted to go over this. A lot of the questions were around, should I take out this? Is this scheme good? Or what are the restrictions on this scheme? And what about, can I rent my property out after 6 months? That was a big question. I really want to clarify this. So just to give you just to explain, there's a number of different grants and a number of different schemes. A lot of them are state-based. There's national ones. This is one that's national, and it's called the First Home Guarantee Scheme. We talked about parental guarantees and how your parents were securing, you were using the security guarantee of your parents' house to enable less deposit and not pay mortgage insurance. Well, this is kind of the same thing, but it's the government guaranteeing you, not your parents. So it's enabling you to buy with a 5% deposit, and they're covering the mortgage insurance by offering a guarantee. They're guaranteeing that mortgage insurance. Now, it differs to some of the other grants, though. So with the stamp duty concession, you can live in that house for 6 months and then rent it out afterwards. With a first home guarantee, there's a guarantee attached to your loan. And until that guarantee is released, the same way you release a security guarantee for your parents, you've got to get it valued and get it properly released. You cannot rent that property out. So that's one of the big restrictions. One of the other big differences is there's spots, there's places that come out. So you're not guaranteed a spot. There's certain places that come out and they're given to certain banks. So different banks have different spaces. So we can help navigate that for you. There's 32 banks that have these spaces at the moment. Some of the banks that we're using are Unibank, Commonwealth Bank, National Bank, Teachers Mutual, and Great Southern Bank. But I guess it's really helpful. It's a really helpful grant if you've only got that 5% deposit. But I just think you need to really think about if you're going to rent that property out, that might not be for you. There's a couple of requirements. You need to have your notice of assessment done. So if you're looking at buying in July this year, just make sure you get your tax done nice and early. There was a few people that got held up last year having to wait for their tax to be done because the government do need your notice of assessment to work out that's what your income is checked on. There's two other, so that's basically the first home guarantees. I just wanted to explain that a little bit more. Now, there's two other ones that are very similar. There's the regional, which is, that's down the second last point. Now, that's the same thing as the first home guarantee scheme, but it's only for regional people. So if you live in, say, Dubbo and you want to buy a property in Dubbo, there are certain spaces that have been allocated just for you. And somebody from Sydney can't take that space. Now, if you were living in Sydney and you wanted to buy in Dubbo, you would not qualify for a regional grant because you have to be living there first. The last one is the family home guarantee. So this one's a little bit different. It is for single parents. You only need a 2% deposit, which is great. And another fundamental difference is it's not only for first home buyers. So you may have come out of a relationship and you're a single parent now and you didn't quite get enough to get into the market. This is really there to help you get back in as well as to help first home buyers. So as I said, I didn't want to go really deeply into government grants, but I did want to clarify this one because there were so many questions on that. Again, if you've got any questions, please reach out to the team. We would love to let you know what you're eligible for. I just will note too that one of the other questions that I saw that I thought might be worth noting is these guarantees and grants and things like this can be layered. So you can qualify for the state grant of getting a stamp duty concession. You might get the first home buyers grant for a new property and get the first home guarantee scheme. So you can have multiple grants. So it's good to work out all the things that you're eligible for. And even if you're not ready to buy now and you're getting on that plan to buy, you want to know what you're eligible for so you can start to set your goals. Well, that concludes the, I guess, the content part of our webinar. I have a huge amount of questions here, and I'm going to try to get through as many as I can. If I don't get through your questions, I'm going to say it again. Please reach out to the team at hello@spherehomeloans.com.au. One of my team will come back and answer your questions specifically. A lot of you have asked quite specific questions in the webinar questions. How much can I borrow? What can I qualify for? Anyone who's asked one of those questions, I'm going to have one of my team come back to you within 5 days with an answer of your question. So if you've asked a question, all of the specific ones, there was a lot of specific questions. I'm not going to answer them on here because they might be specific to you, but I'm going to have somebody come back and answer those for you. If you have another question, reach out, we'll come back to you. If you have any other questions too, we've got some sitting up there on the Q&A that I might get time to get to as well. So there are a few great questions here. The first one is Damien, and he's asked, should I pay stamp duty or go for the annual land tax? Just to clarify, for those of you who don't know, the stamp duty concessions state by state go up to a certain amount. There's a new thing that came out that means that you can choose, if you have to pay stamp duty, whether you pay stamp duty or an annual land tax. So the answer is you really have to work it out both ways. Now, I'm just going to give you a scenario here to actually work that out. So if you're buying for $1 million, and I'm just going to assume that you're buying in New South Wales, your stamp duty might be $40,000. Now, if you had a $100,000 deposit, you have no choice other than to pay the land tax because you don't have enough funds to get in. But if you have, say, a $200,000 deposit, we're going to work that out both ways. Now, if you went the land tax option, you might have, just depending on what the land's worth, your land tax might be, say, $2,000 a year, and you have to pay that ongoing. Now, if you were going to sell that property in 5 years' time, even if you had the funds to pay the stamp duty, you would have been better off paying the land tax, because in 5 years, you're only going to pay about $10,000 in land tax. So even if you had ample deposit, the land tax option might be best for you. But if you had planned on buying that, holding that property for, say, 50 years, even assuming that the value of the land doesn't go up, because obviously land tax is worked out on the value of your property, even if it doesn't go up, over 50 years, you'd be paying $62,000 in stamp duty. So I think this incentive is a great one for people who can't get in without it. And I think even some people who could get in without it should opt for it, because in the short term, they might save a lot of money, or if they're going to sell in a certain amount of years, they would still come out ahead. But I think it's worthwhile working it out both ways. Next is Geraldine's asked, is it common that a lender is not offering pre-approvals at the moment? It is definitely common that there's a lot of lenders out there that have stopped doing what we call fully assessed pre-approvals. So they were clogging up their systems, and some of them have said, look, it's not actually worthwhile for us to do this. We will do just an indicative approval. So some lenders are just doing what they're doing, a credit check. And if you've got a certain income and the broker checks that, they will say, we're just going to give you an indicative approval. It's not a fully assessed approval. Some people are happy with that. There's some clients that really want to have a fully assessed approval, and we might choose the lenders based on who gives a fully assessed approval. That's important to a lot of clients. If anyone had bonus income, or if they were self-employed, I'd insist that they got a fully assessed pre-approval. But yes, it is actually quite common at the moment, and it is quite frustrating in some cases. So sometimes we are choosing lenders that are offering the fully assessed pre-approvals because that's important to people. Kathleen asks, do I need to close my Afterpay or ZipPay accounts before I can be considered for a loan? How many months of statements will I need to provide to a broker? And does it affect obtaining a pre-approval if you're in a probation period? I might just segment that and answer the probation period first. You can borrow if you're in a probation period with most lenders. Probation period isn't a terrible thing. What they will look at is how long you've been in your job and how long you've been in your industry for. So if you're borrowing with 80% with a lot of banks, they just look at your one payslip, one employment that you're in. If you're borrowing 95%, you've got a mortgage insured loan, there's a lot more risk attached to that loan. So even if the bank has a policy that they're going to take you after short-term employment, the mortgage insurer might want to see that you've got not either 1 year in your current employment or 2 years in the same industry, no breaks. So you can borrow if you're on probation period, but depending on the percentage of the lend that you go to, different banks will have different policies about that. And you might, if you're having to pay mortgage insurance, I would just workshop that first. And with Afterpay and ZipPay, do I need to close them? Well, look, you don't have to close them. When we do an appointment with a client and we're doing the fact find and we're getting all of your information in and before we can give some recommendations, one of the things that we will do is an Equifax report, and we will have a look at your credit score. So that's going to let us know what the bank is going to see when we put your loan in. Now, if your score is something that we're maybe concerned about, we might come back to you and say, look, I really think you need to close all these bits and pieces before we apply for a loan. We won't apply for loans that we don't think are going to get approved. So we're going to get you in the position we can best. Now, if you're asking, so you don't have to pay out ZipPay and Afterpay, but there might be a case where that works best for you. Now, how many statements will you need to provide the broker? Generally, you need to give 3-month statements, but that can vary between banks. And look, it's important to know too, with that Equifax report, there's a thing called open banking. So you might close a facility, and this is quite common. You might close a facility thinking that, I want to close that because I don't want to give statements to the bank. Using this open banking platform, a bank can see your transactions on all of your credit facilities for the last 2 years. So I guess it's really important that your conduct is right. Now, it doesn't mean that you're going to be declined because you're late on a credit card 6 months ago, But I guess getting your accounts in order is a really important thing. And sometimes we would say to close after pay and zip pay. Next is Sam has said, hi, I'm looking at getting a first investment property and fortunately have the option for a parental guarantor. Where do you stand on paying down help debt first or maximising the investment property deposit? Sam, it is awesome that you've got the ability to have a guarantee. Look, I really feel like going back to that session, we really need to work this out for you. So I'll get someone from the team to come back to you and work that out. But I guess my personal opinion on paying out help debt, because you've asked where I stand, is I think help debt is good debt. And because you only pay off at a certain amount, if you can facilitate your goals and keep that help debt, I'm not I'm not pro paying it out. I bought my first home while I still had quite a sizable help debt, and I don't regret it. And I have never regretted it. I've done lending for nearly 20 years now, and I don't think I've ever had a client say, oh, I wish I waited to get into the market. I wish I'd waited a little bit longer before I entered the market. Now, I've had people say, I wish I borrowed less. I wish I didn't go so big for my first time. I put myself into some trouble. But I've never had someone say, I wish I'd waited to get into the market. So I think we'll just work that out for you. Marie asks, when do I start looking for a new mortgage provider? My fixed rate is about to stop and I want to know when to start looking. I think, Marie, so you've obviously got a home loan now. I think there's a lot of people in your position. There's a lot of people that have taken out a really cheap fixed rate and they're about to come off and they're looking at the rates now and going, wow, I'm about to jump from 2% to 4%. And that could be a little bit scary. Or 2% from 5%, and that could be a little bit scary. To answer your question, I think that you should start looking 6 weeks out. So if you've 6 weeks before your fixed rates coming up to maturity is a good time to start to talk to a mortgage broker, work out what's out there. Now, you might not need to refinance. You might not need a new mortgage provider. You might be able to negotiate a great rate with the bank that you're with, and we can help you with that. But you want to be able to compare. Now, don't think that there's a timeline. Now, the bank sometimes sends out letters and say, you know, your fixed rate's coming up, you need to take action. You don't need to take action. You don't need to refix. You don't need to make a decision. The worst case that happens if you don't act right away is that you'll roll over to the variable. Now, you might roll over to the variable while you want to make a decision. It might not be something you've got the capacity to think about right now. So it's not the end of the world if you let it roll over. But if you're thinking about maximizing or minimizing the amount of interest you pay, 6 weeks out would be a great time to talk to a broker. Alvin asks, when buying your first investment property, does it always need to be a 20% deposit? Can it be lower? I don't have an owner-occupied home to use for equity. Alvin, no, it doesn't. So you can borrow really easily up to 90% of the value of an investment property. Some lenders will even go to 95% for investment properties. You don't need to have, and some clients that have a 20% deposit opt to hold some back and pay mortgage insurance to help their goal of buying more property. So I think the best thing to do is to work out at, you know, if you don't have a 20% deposit and you have a little, you know, you need to borrow a little bit more, what the mortgage insurance would be at each level. So you could come back to ask us scenarios about, if I put in 10%, what would the mortgage insurance be? If I put in 5%, what would the mortgage insurance be? And just work out how much the mortgage insurance is going to jump up at each different level. And then you can make an informed decision about what's best for you. Gillian asks, is 38 too late to buy your first property? Absolutely not, Gillian. Get into the market. I always think that you get into the market when you can. 38 is actually pretty young. It's a pretty average age to get into your first home. So your 20s, you've been studying and saving. 30s is generally the time people are buying their first home. I've done first home buyer loans for people in their 50s. I've done a few for people in their 60s. So I think you get in when you can get in. As long as you're comfortable with the repayments, if you are buying and you're a little bit older, you're not at this sort of level. But if you were buying your first home at 55 and you wanted to have a 30-year loan term, you could do that if you had a sufficient exit strategy. So, you know, we just have to say to the bank what you're planning on doing on retirement age. So if you wanted to borrow on a 30-year loan term and you had ample super, we can put up a case to give you a longer loan term and things like that. But there's not an age that's too old, and 38 certainly isn't even anywhere near old for us. I'm just going to pop up to the live chat and see if there's any I'm just going to have a look. I'm just having a look at the chat to see if there's any live questions that somebody wants me to ask. I've seen one here from Glenn James, so I better answer it. It says, great webinar. Is it a general rule of thumb that one child is worth 50,000 in borrowing capacity? No, it's not. This was only a scenario that I had in the calculator, and I've just added 2 dependents. So for these clients in their financial position with their incomes, it took 100,000 off, but no, it's definitely not a rule of thumb of 50,000. Someone's asked if they can get a recording of the session. Yes, you absolutely can. Someone's asked, we can send that out. I think Glenn's going to put it on a YouTube a little bit later. And Melanie's asked, were the applicant's wages before or after tax? In that scenario, it was before tax. But again, please don't use that as a guide of what you can borrow. Again, that's just a separate scenario. I really use that scenario just to show you some of the impact that different debts have on borrowing capacity. One of the questions here, I think this is a good one. It says, can parental guarantees be used with an overseas property? Unfortunately, no, it can't. It does have to be an Australian property. One of the questions here is, you said you wanted to get a notice of assessment. Yes, you do need your notice of assessment. So when you're doing that first home buyer scheme, the guarantee scheme, the bank won't look at your group certificate. You need to have done your tax, and you need to provide your notice of assessment. Oh, I have some parents that are asking if they can do multiple children, if they can offer guarantees for multiple children. I'm sorry, I missed that. Yes, you can. So some banks will allow you to do up to 3 guarantees. So we have done we have done guarantees for parents where they've offered up to 3 guarantees. I don't know if somebody's doing more than that right now, but in my experience, I've done up to 3 guarantees. So we can definitely do 3. But yeah, please reach out to us and we'll let you know. But yeah, you can do 3 guarantees if the property that you own allows that security-wise. Now, we are just out of time. I'm so sorry I didn't get to all of your questions. If there's anything that you would like to know, I would love you to reach out to the team, hello@spherehomeloans.com.au, and someone will come back and answer your questions. Thank you so much for your time. I know it's a late evening, so I really appreciate everybody coming on, and I will talk to you soon.